I got to ask you, 3.9% unemployment this morning, but on a year-over-year basis, wages go down. What does that tell you as a former policymaker about inflation dynamics or the economy?
Well, welcome to Hoover, Mike. It's great to have you here. The economy's strong. That's first thing what it tells me. Starting last May until now, the economy continues in the U.S. to have some acceleration, to have some positive momentum. 3.9% unemployment rate is strong. On the wage front, I would say we're not capturing what I think are the underlying trends in wages. Wages are moving up in the U.S. I'd say some of the reason why the data doesn't suggest it is there's huge mix changes in that. We see some people with less than high school educations coming into the labor force. They're coming at a lower wage rate, but they've got opportunities now. So my guess is in 2018, when all is said and done, you're going to have the biggest increase in real wages we've had in a dozen years or so.
Well, given the statistics, with unemployment at 3.9% and PCE inflation at 2%, the Fed can argue it's met its mandates. So do these numbers suggest any different kind of policy response?
So I hope not. I hope the Fed isn't hanging their hat on data that comes from the Bureau of Labor or the Department of Commerce on days like this. It's noisy data. The underlying trends in the economy are strong. Don't want central bankers to be too myopic and to be looking at too fine of this data. The underlying trends are strong. I suspect that they didn't see anything this morning that would change fundamentally their views.
Well, their mission, low and stable inflation, they set a target of 2% to get to that. They can argue mission accomplished, but you've never been a fan of that 2% target. What's wrong with it? What would you do instead?
Well, every once in a while I call it the clean, well-lit prison of one idea. 2.0% inflation is sometimes consistent with price stability. So is 1.63%. We shouldn't use these decimal points and take them too seriously. Broadly, my view is the Fed's been running policy that's been consistent with price stability for some number of years, and that we know somehow the difference between 1.7, 1.9, and 2.1% inflation is really silly. Our data isn't that good. But on the wage front, I think the truth is the Fed, in my view, shouldn't overreact if they see an improvement in wages over the course of this year. That's a catch-up after a decade of low wages. They're at around their price stability objective. They should be setting policy based on where they think the economy is going to be 12 months from now or so. And as we learned in the crisis, price stability and financial stability are two very different things.
Jay Powell seen in the markets as a steady hand continuing on the policies of Janet Yellen, basically. Is that an accurate impression of the chairman?
So I've known Jay for a long time. I think he's a really good guy. I think he's got really good character. My guess is that those attributes are more important over the next 3 or 4 years than some people in markets might believe. I suspect this is a continuity Fed, but I'm looking for Chairman Powell and the new team that the president and the chairman assemble to, after they get their feet under them and they put in place much of Janet Yellen's policies, I'm hoping they spend a few years after that really reforming the institution. So I think 2019 might be the first year before you see a new chairman put his imprint on the institution. And for purposes of continuity, that strikes me as a good thing.
You've argued that the one thing that's on autopilot that he wouldn't be affecting, the balance sheet, is something that needs attention.
Yeah, so, we can't go back to 2012, 13, or 14. My own judgment was the same as Chairman Bernanke's in the depths of the crisis and during QE1 and QE2, which was we cut rates to zero, we grew the balance sheet. For symmetry, then we should shrink the balance sheet before we go to rates. The Fed had other ideas, so we end up with a $4 trillion balance sheet in the U.S., growing central bank balance sheets everywhere else around the world. The balance sheet's where the money is. The balance sheet strikes me as the thing that's most important to asset prices and about which central bankers and economists should be most uncertain when this trajectory changes.
Well, since we know what the plan is to reduce the balance sheet, is there a specific problem that you see arising in the economy?
So I think, as you suggest, inertia is pretty powerful at this point in 2018. So the autopilot in the balance sheet in the U.S. is probably going to stay. But what happens to other central bank balance sheets, I'm less sure. I'd say the underlying trends in the U.S. economy are strong. The U.S. has been growing around 3% over the last quarter or two. I expect that trend to continue. Global growth around 4%. Global trade around 5%. These are the kinds of numbers that we were told for the last few years were impossible. So that's encouraging. But I would say there are some real risks. And the most principal risk is the G2 fight happening right now between the U.S. and China. As we sit here today, I suspect the American delegation is on their way back to the U.S., but I would not underestimate the risks of the G2 fights ending up with a broader fight in the G20, and that can have real effects on global supply chains, asset prices, and the global economy.
Well, we did have what appears to be a failure of the talks in Beijing. What does it mean for the U.S. economy?
So it's not good news. Trade is a win-win proposition when done right, and it's a lose-lose proposition when done wrong. I expect things will get tougher on this. I expect markets will come around to the view that it's harder to get a deal than many market participants might have thought a week or a month ago. And I suspect as we get closer to the elections here in the U.S. in November, that deal gets harder and harder to get done. So there are huge gains that can be made. One example is the U.S. could become a big exporter of services into the Chinese economy to offset the bilateral trade deficit. But it's not obvious that the two sides have the depth of relationship below the level of President Trump and President Xi to get that stuff done. It is most helpful in Chinese-U.S. relationships to have a base of knowledge, a base of relationships, so you can really have tough and important discussions. I suspect this thing has a lot more rounds to go, and there can be some pretty tough times ahead.
Fiscal stimulus. We've had it now for a couple of months. People knew it was coming, and yet there doesn't seem to be any reaction in the economy. Business investment going down over the last couple of months. Consumer spending very light. When does it kick in, or does it?
Well, unfortunately, in economics, we don't have the benefit of running a control group. So we had two policy changes at least hitting the economy. One was a big increase in government spending that some would suggest are going to have huge multipliers and grow the economy. At the same time, we have a pretty radical change in tax policy that could do a lot to change the supply side. 12 or 18 months from now, I worry that both sides run to their corners and say, my policy worked and the other one didn't. We're not going to know for sure. My guess is what we're going to see is a deepening of capital in the U.S. economy as we get through this year, especially in the second half, that you will see incremental investment in property, plant, equipment, and software. That's been the missing ingredient over the last 10 years of this recovery. It's also why productivity's been low and wages have been low. So we're going to run the experiment about whether there's an opportunity for companies to invest. New capital, new workers can drive a whole change in the economy and sustain the level of growth above 3%.
Save the last tough question for the last question here. You were an advisor early on to President Trump. You interviewed with him for the Fed chair's job. There is an impression on Wall Street that he doesn't know much, if anything, about economics. Is that right or wrong?
Well, certainly, I guess the tough question at the end, Mike. So I was on one of these CEO advisory panels, which was disbanded. Then I met with the president as part of a final interview to the Fed, and I didn't get that job, so I'm 0 for 2. So I'm probably not the best guy to offer this view. Listen, I think the president knows what he was looking for in many of these posts. I think the president's been in office 14 or 15 months. Being president is a fundamentally different job than any other job in the economy. And I think if you look at the underlying data, he's got to be pretty pleased with the improvement in the economy. But if you look at the risks, the China risk just being one of many, I think he shouldn't be, nor should the administration be complacent and be putting points on the board before it's due.